Hello and welcome. In this course, we will explore separate financial statements based on International Accounting Standard 27. The International Accounting Standards Board adopted IAS 27 in April 2001. This standard focuses on consolidated financial statements and accounting for investments in subsidiaries. It originally replaced an earlier standard from 1976, known as IAS 3, which covered consolidated financial statements. However, IAS 27 does not include the parts related to accounting for investments in associates, which are treated separately. In December 2003, the board released an updated version of IAS 27, which was renamed to Consolidated and Separate Financial Statements. This revision was included as part of the board's early technical projects. The updated standard also brought in important guidance from two related interpretations. These interpretations covered special purpose entities and the treatment of potential voting rights and ownership interests when consolidating financial statements. In January 2008, the board made changes to IAS 27 to improve how non-controlling interests and the loss of control over a subsidiary are accounted for. These changes were part of a broader project on business combinations. Later, in May 2011, the board issued a new version of IAS 27 with a focus on separate financial statements. The principles of control and the rules for preparing consolidated financial statements were then covered under a different standard called IFRS 10. In October 2012, IAS 27 was updated as part of amendments related to investment entities. These changes introduce new rules about what information investment entities need to disclose. Then, in August 2014, further amendments allowed companies to use the equity method to account for their investments in subsidiaries, joint ventures, and associates when preparing separate financial statements. IAS 27, which covers separate financial statements, is organized into 20 paragraphs, all of which hold equal importance. The standard keeps the original format from when it was adopted. To fully understand IAS 27, it should be considered alongside its objectives, the underlying reasons for its conclusions, and other key IFRS materials like the conceptual framework for financial reporting. When there is no clear guidance in IAS 27, IAS 8 provides a framework for choosing and applying accounting policies. The main goal of this standard is to set out how companies should account for and disclose their investments in subsidiaries, joint ventures, and associates when preparing separate financial statements. This standard applies to the accounting of investments in subsidiaries, joint ventures, and associates whenever a company chooses or is required by local laws to prepare separate financial statements. However, the standard does not decide which companies must prepare separate financial statements. It only applies when those statements are prepared in accordance with international financial reporting standards. This standard uses specific terms with particular meanings. Consolidated financial statements refer to the financial reports of a group where the assets, liabilities, equity, income, expenses, and cash flows of the parent company and its subsidiaries are combined and presented as one single economic entity. Separate financial statements are those prepared by a company that can choose to account for its investments in subsidiaries, joint ventures, and associates either at cost, using financial instrument standards, or by applying the equity method. Several important terms related to financial reporting are defined in other standards. These include concepts like associate, control of an investee, equity method, group, investment entity, joint control, joint venture, joint venturer, parent company, significant influence, and subsidiary. Separate financial statements are prepared in addition to consolidated financial statements or when an investor does not have subsidiaries but has investments in associates or joint ventures. In such cases, the investments are accounted for using the equity method, except in specific situations outlined by the relevant accounting standards. Financial statements are not considered separate financial statements if the entity does not have any interest in a subsidiary, associate, or joint venture. Some entities are exempt from consolidating subsidiaries or applying the equity method, and in those cases, they may present separate financial statements as their only financial reports. Additionally, investment entities that are required to apply the consolidation exception for all their subsidiaries during the current and prior periods also present separate financial statements as their sole financial statements. Separate financial statements must be prepared following all relevant IFRS standards, with some exceptions. When preparing these statements, a company can choose to account for its investments in subsidiaries, joint ventures, and associates in one of three ways: at cost, using financial instrument standards, or by applying the equity method. A company must apply the same accounting approach to all investments within each category. When investments accounted for at cost or using the equity method are classified as held for sale or for distribution, they should be accounted for under the standards that deal with non-current assets held for sale. However, investments accounted for under financial instrument standards do not change their measurement in these situations. If a company chooses to measure its investments in associates or joint ventures at fair value through profit or loss, it must use the same approach in its separate financial statements. When a company chooses to measure its investments in associates or joint ventures at fair value through profit or loss, it must apply the same method in its separate financial statements. Similarly, if a parent company is required to measure its investment in a subsidiary at fair value through profit or loss, it must also use this approach in its separate financial statements. If a parent company is required to measure its investment in a subsidiary at fair value through profit or loss, it must apply the same method in its separate financial statements. When a parent company changes its status by either becoming or ceasing to be an investment entity, it must account for this change from the date it happened. If the company stops being an investment entity, it should then account for its investment in the subsidiary following the usual rules. The date when the status changes is treated as the acquisition date, and the fair value of the subsidiary at that time is considered the value transferred for accounting purposes. When a company becomes an investment entity, it must measure its investment in a subsidiary at fair value through profit or loss. Any difference between the previous carrying amount and the fair value at the date of this change is recorded as a gain or a loss in profit or loss. Also, any cumulative gain or loss previously recognized in other comprehensive income for those subsidiaries is treated as if the company had sold those subsidiaries at the date of the status change. Dividends from subsidiaries, joint ventures, or associates are recorded in the separate financial statements when the right to receive them is established. These dividends are recognized in profit or loss unless the company chooses to use the equity method, in which case dividends reduce the carrying amount of the investment. When a parent company reorganizes its group by creating a new parent company, certain conditions must be met. The new parent must gain control of the original parent by exchanging equity instruments. The assets and liabilities of both groups must remain the same immediately before and after the reorganization. Additionally, the owners of the original parent must maintain the same ownership interests in the net assets before and after the change. In this situation, the new parent records its investment in the original parent based on the carrying amount of its share of equity in the original parent's separate financial statements at the date the reorganization takes place. In the same way, an entity that is not a parent may create a new parent company if it meets the same conditions described earlier. The same rules apply to these reorganizations, with the terms original parent and original group referring instead to the original entity in these cases. An entity must follow all relevant international financial reporting standards when providing disclosures in its separate financial statements. When a parent company chooses not to prepare consolidated financial statements and instead presents separate financial statements, it must disclose several key points. These include stating clearly that the financial statements are separate, explaining that the exemption from consolidation has been applied, and providing the name and main location of the entity whose consolidated financial statements have been made available to the public. The entity should also share where those consolidated financial statements can be accessed. An entity must provide a list of its important investments in subsidiaries, joint ventures, and associates. This list should include the names of those entities, their main locations and countries of incorporation, if different, and the percentage of ownership interest held by the reporting entity. If the ownership interest differs from the voting rights, those proportions should also be disclosed. Additionally, the entity should explain the method used to account for each of these investments. If an investment entity that acts as a parent prepares only separate financial statements, it must disclose this fact. Furthermore, it should include the disclosures required for investment entities under the relevant standards for interests in other entities. When a parent, except those covered by paragraphs 16 to 16a, or an investor with joint control or significant influence over an investee prepares separate financial statements, they must identify the financial statements prepared under IFRS 10, IFRS 11, or IAS 28 to which their separate financial statements relate. Disclose that the financial statements are separate financial statements and explain why they are prepared if it is not legally required. Provide a list of significant investments in subsidiaries, joint ventures, and associates, including the name of each investee, the principal place of business and country of incorporation, if different, the proportion of ownership interest held, and the proportion of voting rights, if different, a description of the accounting method used for each investment. The entity shall apply this standard for annual periods beginning on or after the 1st of January 2013. Earlier application is permitted. If an entity applies this standard earlier, it shall disclose that fact and apply IFRS 10, IFRS 11, IFRS 12, and IAS 28 as amended in 2011 at the same time. The investment entity's amendments to IFRS 10, IFRS 12, and IAS 27, issued in October 2012, amended paragraphs 5, 6, 17, and 18, and added paragraphs 8A, 11A, 11B, 16A, and 18B, 18I. An entity shall apply those amendments for annual periods beginning on or after the 1st of January 2014. Early adoption is permitted. If an entity applies those amendments earlier, it shall disclose that fact and apply all amendments included in investment entities at the same time. At the date of initial application of the investment entity's amendments, which for the purposes of this IFRS is the beginning of the annual reporting period, when those amendments are applied for the first time. If a parent concludes that it is an investment entity, it shall apply paragraphs 18C to 18.1 to its investment in a subsidiary. At the date of initial application, an investment entity that previously measured its investment in a subsidiary at cost shall instead measure that investment at fair value through profit or loss, as if the requirements of this IFRS had always been effective. The investment entity shall adjust retrospectively the annual period immediately preceding the date of initial application and shall adjust retained earnings at the beginning of that immediately preceding period for any difference between the previous carrying amount of the investment and the fair value of the investor's investment in the subsidiary. At the date of initial application, an investment entity that previously measured its investment in a subsidiary at fair value through other comprehensive income shall continue to measure that investment at fair value. The cumulative amount of any fair value adjustment previously recognized in other comprehensive income shall be transferred to retained earnings at the beginning of the annual period immediately preceding the date of initial application. At the date of initial application, an investment entity shall not make adjustments to the previous accounting for an interest in a subsidiary that it had previously elected to measure at fair value through profit or loss, in accordance with IFRS 9, as permitted in paragraph 10. Before the date that IFRS 13 fair value measurement is adopted, an investment entity shall use the fair value amounts previously reported to investors or to management if those amounts represent the amount for which the investment could have been exchanged between knowledgeable, willing parties in an arm's-length transaction at the date of the valuation. If measuring the investment in the subsidiary in accordance with paragraphs 18C, 18F is impracticable, as defined in IAS 8 accounting policies, changes in accounting estimates and errors, an investment entity shall apply the requirements of this IFRS at the beginning of the earliest period for which application of paragraphs 18C, 18F is practicable, which may be the current period. The investor shall adjust retrospectively the annual period immediately preceding the date of initial application, unless the beginning of the earliest period for which application of this paragraph is practicable is the current period. When the date that it is practicable for the investment entity to measure the fair value of the subsidiary is earlier than the beginning of the immediately preceding period, the investor shall adjust equity at the beginning of the immediately preceding period for any difference between. The investor shall adjust equity at the beginning of the immediately preceding period for any difference between the previous carrying amount of the investment and the fair value of the investor's investment in the subsidiary. If the earliest period for which application of this paragraph is practicable is the current period, the adjustment to equity shall be recognized at the beginning of the current period. If an investment entity has disposed of or lost control of an investment in a subsidiary before the date of initial application of the investment entity's amendments, the investment entity is not required to make adjustments to the previous accounting for that investment. Notwithstanding the references to the annual period immediately preceding the date of initial application, the immediately preceding period, in paragraphs 18C, 18G, an entity may also present adjusted comparative information for any earlier periods presented, but is not required to do so. If an entity does present adjusted comparative information for any earlier periods, all references to the immediately preceding period in paragraphs 18C, 18G shall be read as the earliest adjusted comparative period presented. If an entity presents unadjusted comparative information for any earlier periods, it shall clearly identify the information that has not been adjusted, state that it has been prepared on a different basis, and explain that basis. The equity method in separate financial statements, amendments to IAS 27, issued in August 2014, amended paragraphs 4, 7, 10, 11b, and 12. An entity shall apply those amendments for annual periods beginning on or after the 1st of January 2016, retrospectively in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. Earlier application is permitted. If an entity applies those amendments for an earlier period, it shall disclose that fact. If an entity applies the standard but does not yet apply IFRS 9, any reference to IFRS 9 shall be read as a reference to IAS 39 Financial Instruments, Recognition and Measurement. This standard is issued concurrently with IFRS 10. Together, the two IFRSs supersede IAS 27 Consolidated and Separate Financial Statements, as amended in 2008. International Accounting Standard 27, titled Consolidated and Separate Financial Statements and revised in 2003, was approved for issue by 13 of the 14 members of the International Accounting Standards Board. One member, Mr. Tatsumi Yamada, dissented. His dissenting opinion concerned consolidated financial statements and is included after the basis for conclusions on IFRS 10 consolidated financial statements. The members who approved IAS 27, 2003 were Sir David Tweedy, the chairman, Thomas E. Jones, the vice chairman, Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gellard, James J. Lysenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmid, John T. Smith, and Jeffrey Whittington. The dissenting member was Tatsumi Yamada. The amendments titled The Cost of an Investment in a Subsidiary, Jointly Controlled Entity or Associate, issued in May 2008, were approved by 11 of the 13 members of the International Accounting Standards Board. However, two members, Professor Mary E. Barth and Mr. Philippe Danjou, dissented. Their dissenting opinions are included after the basis for conclusions. The members who approved the amendments were Sir David Tweedy, the chairman, Thomas E. Jones, the vice chairman, Stephen Cooper, Jan Engstrom, Robert P. Garnett, Gilbert Gellard, James J. Lysenring, Warren J. McGregor, John T. Smith, Tatsumi Yamada, and Weiguo Zhang. The dissenting member were Mary E. Barth, and Philippe Danjou. The investment entities, amendments to IFRS 10, IFRS 12, and IAS 27, issued in October 2012, was approved for issue unanimously by all 15 members of the International Accounting Standards Board. The members who approved the amendments were Hans Hugervorst, chairman, Ian McIntosh, vice chairman, Stephen Cooper, Philippe Danjou, Martin Edelman, Jan Engstrom, Patrick Finnegan, Amara Louise de Oliveira Gomes, Prabhakar Kalavacherla, Patricia McConnell, Takatsugu Ochi, Paul Pachter, Daryl Scott, Chungwoo Se and Zhengwei Guo. The equity method in separate financial statements, amendments to IAS 27, issued in August 2014, was approved for issue by all 14 members of the International Accounting Standards Board. The members who approved the amendments were Hans Hugervorst, Chairman, Ian McIntosh, Vice Chairman, Stephen Cooper, Philippe Danjou, Martin Edelman, Patrick Finnegan, Amara Louise de Oliveira Gomes, Gary Kabarek, Suzanne Lloyd, Takatsugu Ochi, Daryl Scott, Chungwoo Se, Mary Tokar, and Weiguo Zhang. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.